It's no secret that the stock market has been in a bit of turmoil lately, but it doesn't have to be all bad news for you. In this video, I'll break down some easy steps on how you can make money during these tough times. Welcome to Gold Bull, the place where future successful investors gather and get inspired. If you haven't subscribed yet, I gotta say, you're missing out. Let's dive in. From market crashes comes lost money for investors. But if you have the right mindset as well as investing style, rather than losing money, you can actually make a lot of money. What do we mean by this? Well, let's take a closer look. Peter Lynch, a renowned investor who's achieved an annual average return of 29.2%, actually thinks the same way. We'll be citing an old interview in this video about his thoughts on the market crash. Volatility in the financial markets. Lynch loves volatility. Like when the market went from 1972, when Taco Bell went from 14 to 1, they had no debt and never had to close a restaurant. The volatility is terrific for Lynch, stating that these calls are very important. He doesn't think the market going up 80 points one day and down 80 is good for the public. The market continues to go up and down and hasn't changed a lot in 25,000 years.
I love volatility. I remember when in 1972 the market went down dramatically and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close. I started buying at 7, but I kept onto it and it went to 1. It was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing.
This volatility is a great opportunity if people can understand what they own. Corporate profits double every 9 years and the stock market audits double every 9 as well. Lynch is convinced that the next 3,800 points will be going up and won't go down the trajectory of the market. So the market will end up doubling in the next 8 or 9 years. Then double again 8 or 9 years after that because profits will go up 8% a year and stocks will fall. Why history is important. We should always study history because history is the important thing we learn from when it comes to the market. Since 100 years have passed, the math has always been simple. For example, the market had 50 declines of 10% or more, making it 50 declines in almost 100 years. Then once every 2 years, the market falls 10%. That's actually called a correction, a euphemism for losing a lot of money at an extremely fast pace. Despite its 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in almost 100 years, so every 6 years, the market's gonna have a 25% decline. And that's the main aspect we need to know. You need to know if the market's going to go down, and sometimes, if you're not prepared for it, Lynch doesn't advise you to be owning stocks in the first place. But it's a good thing when declines occur. Like if you purchase a stock at 14, then it declines to 6, that's actually good news. Because if you understand the company's financial history and projections, and they have a promising future ahead, you can hope for that stock to increase to, for example, 22. That's a profit on your stock right there. However, if you buy more of it when it declines to 6 and it increases to 22, that is an exceptional growth compared to when you bought it at 14. So it's good to take advantage of these declines. Despite not knowing when it happens, it's beneficial to take advantage of the market volatility. What to do during a crash. So there are 3 key takeaways Lynch points out. Number 1 is that over the long term, stocks are going to increase because you have to remember that those stocks are part of a business and a business's goal at the end of the day is to make money. Now, do you think in 3, 5, or 10 years' time businesses will be making more or less money? Of course, they'll be making more. Corporate profits grow around 8% due to compounding, so they double around every 9 years, meaning the stock market ought to double in that period as well. Number 2 is that you want to be buying stocks when they are low, when the crash is at its height, because over the long term, things will go back up eventually. The best time to purchase is when it hits rock bottom. Number 3 is to buy good quality businesses. good quality businesses show promise for growth in their financial future, which brings us to arguably one of the most important principles Lynch advises to follow when it comes to investing. Invest in the kinds of stocks that you can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it's very scary that some people aren't careful about investing their money, from purchasing smaller investments like cars and real estate into large stock investments. According to Lynch, people will hear a tip on a bus on some stock and they'll put half their life savings in it before sunset. Then they wonder why they lose money in the stock market. Then once they lose money, they blame it on the institutions. The real answer here is because they didn't do their research. People purchase without looking at the balance sheet or value of the business. This is why the general public does terrible investing. There is a method and reasons for stocks that go up. Coca-Cola, for example, is earning 30 times per share than what they had 32 years ago, while Bethlehem Steel is earning less than they did 30 years ago, meaning its stock value is half than it was 30 years ago. It's important to note that stocks are not lottery tickets. There's a company behind every stock, and when the company does well, so will the stock. It's that simple. Don't try to predict the stock market because, well, it's just a waste of time. There's a reason it's unpredictable. But as Lynch says, these must be in companies that we understand. We must put the time and effort into learning the balance sheet, the income statement, looking at the profits, and comparing it. If you don't go through them, well, odds are you're going to come out on the bottom. Key takeaways. One takeaway from history and from what Lynch has been saying is that the best time to invest in the stock markets is when the prices are cheap. Not necessarily when things are all well and good, because then things are more expensive. Just like Buffett when he gave out one of his best investment advice. When an individual with cash meets an experienced individual, that individual with experience ends up with the cash, and that individual with cash leaves with experience. This goes to show the importance of knowledge, experience, and research. And this can be easily gotten as long as you have the patience and the passion to do so. You can either learn from other experienced people or learn from your own mistakes by partaking in the activity yourself. The options are endless. You just have to keep an open mind because knowledge is power. Hey Gold Bull investor, with all that in mind, did you think we missed any key takeaways? What else would you like to add to Lynch's advice? Comment below and let us know your thoughts. We hope you enjoyed this video and found it useful. We want the very best for you in your investment endeavors, so don't forget to subscribe if you haven't already for more high-quality content updated regularly.